Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Rowan Williams from Nitrogen Fund Managers and Grant Nader from Benguela Global Fund Managers. If you'd like to send questions, please SMS 41392. Email stockwatch@bdtv.co.za. Grant, Rowan, nice to see you both there this evening. Grant, if I may start with you, not a bad day for the market overall. The finish was up about 1/3%. And it seemed that there were two notable features of today's trade, namely the retail stocks catching a bit of a break. In other words, they rallied, and the gold price going to new record highs, although it did retrace from that. Maybe just firstly, the retailers, anything in particular behind their bounce today?
I don't think there was specific news. I mean, we've had this general tailwind of rates that are coming down, and that sort of seems to be becoming more and more consensus, which is supportive of the outlook for retailers. You've got petrol price cuts coming in this Wednesday. So I just think there's a little bit of an undercurrent of positivity that's been, we saw a good month last month, but toward the end of last week, the retailers and the financials came under quite a bit of pressure relative to the miners, who were as gold was rallying and they captured some of the favor of the market. So I think there's a bit of a rebound from that sell-off actually playing out here. Yeah. I don't know if there's anything deeper than that.
Rowan, and as to the gold price performance and gold shares is where you wanted to have had some money this year, and if you hadn't, do you think you've missed the boat? I mean, do you think the gold price is kind of doing like a last parabolic blowout before it all subsides, or do you think this is on course, to the next leg up, seeing as it actually did make a new record today?
Yeah, I mean, gold's quite a sort of divisive asset. Some people think it's a good store of value, a hedge against inflation, while others think it's very much, a historic asset, and there's better alternatives. I mean, what you do see, Bitcoin also reaching recent highs, and that's all, I guess, off the excitement of the pause and in interest rate hikes and possible rate cuts. So I think it's reached a temporary plateau. Where it goes from here, I think, is dependent sort of on geopolitics and the exact trajectory of interest rates. But $2,100 is very full from my perspective. Also, the gold shares, I think, as a result, are also very full. So a reasonable opportunity, if you were lucky or clever enough to be in gold shares at the beginning of the year, I think a fairly good time to start rotating and deploying the capital into other sectors, be it miners or domestic equities.
Yeah. On that note, Grant, is it telling that the gold shares actually came off today, even though at one point the gold price did hit a record?
Yeah, I think gold is incredibly volatile. It does tend to trade like this. Where it goes from here, it's hard to tell. I mean, if you go and speak to a technical analyst, they'll tell you gold is forming the most bullish pattern, breaking out to all-time highs potentially, et cetera, and on that view, you could buy it. If you think it's fundamentally a hedge against geopolitical risk, you could argue that you need to hold on to some. But I think if you need to bear in mind the volatility, as Rowan said. If you've been holding it, you could do worse than taking some profits here, with a likely chance that you'll get another chance to buy it lower. Gold does give you a few chances, and we're seeing that again today. So I don't think gold's coming off unexpectedly. Last week it had the nice move. Last month it was one of the best sectors. So it's typically hard trades.
Yeah. Okay. And well done to anyone who actually bought a gold share at the start of the year and held on, more importantly.
Yes.
Okay, so if we're talking about taking profits, the viewer sent us a question about two shares in very different sectors. The one is Naspers, the other is Advtech. So on the first, being Advtech, he says it's up 30% year to date and 40% from this year's lows. It is, however, at record highs. Is it time to get out? 4 question marks, but if so, where to deploy the capital? I suppose that's the other conundrum. Rowan, if I may start with you, would you sell out of Advtech if you'd managed to hang on to its rally this year? And if so, where would you put that cash?
Yeah, we've liked Advtech for a long time, and it has actually been one of the few growth stories. I mean, it had sort of bumps along the way, but share is doing incredibly well. The profitability has been very strong, and the valuation is improving. So that's all quite positive. They did also announce a appointment of Roy Douglas. Jeff White is replacing him. So that's quite positive. I think, I mean, if you're a bull, you can continue to hold. If you're a bull of private education and backing the management team, I think it still has legs. If you were to rotate it into something else, Curro would be your natural choice, or Stadio, just in terms of staying in the education sector, but moving into a different stock, which maybe has more upside from these levels. Alternatively, there are quite a few well-run sort of mid-cap stocks, strong management teams. One that comes to mind, something I've mentioned in the past, Carp Agree. It's not exactly in the same sector, but maybe broader South African sort of consumer. They're actually more of a specialty retailer than an agri retailer. Yeah. So you pick up those trends. That's on a P of about 5. So maybe you're going from 12 to 5. You see sort of a new doubling there. I think you have to look quite carefully. But I would stay sort of small cap industrial if I were to rotate.
Okay. Grant, what would you do? And sorry, we had the chart up of Naspers, which is a viewer's second question, but hopefully we can get the Advtech share price so you can see what's happened this year. What would you do at this point if you'd had those shares?
Yeah, I mean, we've also liked Advtech. I think they're performing really well, and they've led the way with regard to, maximizing cash generation and not just capex at all costs, which I think was the road that Curro traveled. But they've pulled themselves together, Curro that is, and they potentially are a good, viable alternative. As good as Advtech is, and I love the structural trends they're playing in, to me it looks a little bit stretched here on valuation. If you're taking a 5-year view, I think you can sit tight and hold it. I think they'll earn their way through the valuation eventually. But in the nearer term, it's starting to look quite full. So perhaps, decide what your sort of time frame is, maybe take something off the table and look for something cheaper. But fundamentally, great company, operating very well. And it's difficult to sell out completely out of a good business because you sometimes find you never buy back and you end up missing out on a good long-term story. So from a private investor's portfolio perspective, I would always say perhaps sell some, maybe not sell all, if it's a good company, and try and keep that core holding in there.
Okay. And then what about Naspers? What would you do there? So the viewer says it's up 28% year to date. It'll be going ex-dividend on the 6th of December. I still like tech, more specifically Chinese tech. Is the logical trade then to sell Naspers and buy Process or Baidu? Rowan, going back to you.
Yeah, so we've also liked Naspers recently. I think the narrative there has changed quite considerably. I think there was a period where investors in the market were quite frustrated because the potential to unlock value was there, but the company wasn't taking the right steps. Now I would say the opposite is true. The potential to unlock value is there, and they're taking advantage of it. We've seen a change in leadership. We've seen a change in strategy. The focused buyback program has been quite successful. I think they've bought back already 15% of the free float, so that is very significant. It's ongoing. As the viewer says, China tech is attractive, I think, at these levels from a valuation perspective. My simple answer would be just to hold for the medium term for the value unlock. And I think Naspers or Process remains actually the cheapest entry point into China tech, being at the discount to the Tencent stake and Meituan and a few other assets. So that would, I would say, hold. It's still got quite a bit of legs, even though it's started to re-rate.
Okay. Grant, you're nodding there. Would you be in agreement?
Yeah, I agree with Rowan completely. I think there's more to unfold here. They're finally unlocking value in a significant way that matters. So at worst, you're getting Tencent, which is by far the dominant asset. It's still more than 100% of the value of the share. And at best, you're getting a discount that can close without any additional risk, because if they're successful at this value unlock strategy, which they started to get some traction on, you could see some of that discount close, and then you're getting that extra return over and above Tencent's performance. So I would hold it. I don't think it's expensive. I think on Tencent alone, I would hold it. Plus, you've got the other opportunities of realizing value there from the company itself.
Yeah. Okay. Then moving on to African Rainbow Capital Investments. And the viewer says it announced a 750 million rand rights offer at 5 rand a share. However, the shares of ARK Investments traded today between 4.90 and 4.78. So it seems to me it doesn't make sense for investors to take up their rights and participate in the rights offer. What am I missing here? Grant, just staying with you, what are we missing if it's trading below the value at which it's going to issue more shares?
I mean, excellent question. I think this is the market's way of saying they're not happy with this proposal. And if you recall, there's been a number of times this management team has talked about buying the shares back and delisting because of the discount to NAV. And now they want to do a rights issue at a significant discount to that same NAV of R9 plus that they've had.
11.
I don't think. I don't like the rationale. I don't think they've got a good track record of creating value and making smart acquisitions with a clear investments strategy and monetization strategy. So I would also, you might find it's shareholders exiting. I'm not sure what the rationale for the discount is, but it's clear that the market is not happy with another issue of shares. And of course, there'll be a nice management fee attached to that capital price, likely.
Yeah, although they were quite sort of defensive about that. It didn't sound like it. I mean, Rowan, what do you make of it? And they've said that they think maybe going to the market was a mistake. But yes, and why raise capital if you're going to delist? I asked them that question. They said that for two separate functions. Do you think that's a fair answer?
Yeah, it has been quite a sort of convoluted situation. I think you're getting this kind of dissonance between what management thinks that the underlying portfolio is worth and valuing it accordingly, and then what the market places on the shares. I guess a level of frustration from management. I think what they're trying to signal is that they see value in the portfolio and a certain group of shareholders. So the NAV is 11. The rights issue is at a discount to that. So it's still a good deal, notwithstanding that you can buy the shares more cheaply. It's sort of a vote of confidence and to sort of, bolster the capital. So I think it's quite a select group of investors that are likely to participate. But I guess the fund manager is saying our job is to manage the portfolio and raise capital in an appropriate manner for the portfolio. I guess it does beg the question, is a listed vehicle the right vehicle for private equity assets? Because we see this with other sort of private equity holding companies, similar kind of discounts, and which sort of just leads to frustration and sort of confusion almost by investors. So I guess you'd have to see how it plays out. Ultimately, the valuation should bear out in terms of the underlying portfolio. But I think, individual investors, may do well. If you believe it, just buy the share, I guess, would be the simple answer, instead of, subscribing for rights.
Then there's a question on the capital appreciation interims. I have to confess that the set of interims that I didn't read today, Rowan, did you look at them and what did you make of them?
We did, yeah. So what we have seen is in the lead up to these results, so the shares corrected quite significantly. They come up with sort of an update and then actual trading update. So I guess the overall the underlying performance was reasonably good, but the HEPS went backwards. I guess depending which number you look at, about by 7%. It was sort of considered to be a growth company, software and payments in particular. So two nice niches that it's in. To some extent, they have sort of embarked on an expansion program, and some of those investments haven't paid off yet in this half, but they expect them to pay off in the second half. So it could be a good entry point. We have been interested in the company, and it looks quite reasonable at these levels. They've got about a third of their market cap in cash. So that makes it quite attractive. Again, it's actually another of these investment companies that is sort of trading, it looks like, less than the sum of its parts. So, but they have, I think, a clear strategy of building a business and a good management team, strong management team. They've got a reasonable track record of deploying capital in the areas that they focused in. So I think they will do better in H2, and it's sort of a pause in their growth trajectory. So possibly an interesting entry point here. Okay.
Grant, do you follow them closely at all?
I used to. They're a bit small for us in terms of investable equity, but I certainly like the company. I agree with Rowan. I like the management. I like the strategy. And they're actually quite successful in their two niches. And they have a lot of cash. It's a cash generative business. It's not trading too expensively. I think times are tough. They've been feeling the pinch of inflation in terms of their cost management. I do think this is one you'd put in the bottom drawer, and you'd be pleasantly surprised in a few years' time what they deliver. But again, it's a small cap. You obviously allocate accordingly. Don't pile in.
Okay, don't stick it all in there. Then there's a question on Brookfield Corporation. So, Rowan, I think it's directed at you. I don't know if this is a share that you're familiar with. I've not heard of this company before, I confess. So, can you enlighten us?
Sure.
Or can anyone enlighten us? Grant.
I think it's the Canadian Infrastructure Investment Fund. It's a very large company, if it is the one I'm thinking of. It's like the Canadian Warren Buffett is the reputation this guy has.
Okay.
They invest in infrastructure globally. I don't know more than that, other than if it is that company, it's highly rated, it's regarded as very high quality, a very good business. I can't comment on price and valuation, etc. But they're playing in infrastructure, which is a very robust sector, and in terms of driving long-term steady returns, it's a good place to be.
Rowan, do you have anything further to add there?
No, yeah, the name is familiar, but I'd have to look up my notes, and we'll go with Grant's assessment.
Maybe just to add on to this, I mean, infrastructure investments, are you buying these because you're sort of fairly guaranteed of a yield, the investment in like a concession in a toll road, for example, you know what you're going to get out, and then you're getting that, and it probably increases at maybe inflation, and you're getting it in a hard currency. Would that be the theoretical underpinning to or the thesis behind something like this?
Yeah, I think so. So what I guess it's utility-like in its returns, as you sort of have described. I guess to some extent, it is a yielding asset, like REITs or property would have similar characteristics. And I guess if you believe that we are at the peak of the interest rate cycle, and we're going to see that coming down, if it has sort of bond-like properties, then it should actually appreciate more than the yield. You'd get capital appreciation as well. So that may be a reason that it is an interesting entry point for these yielding kind of assets. If it's got quality and strong commitments from whichever sort of its renters are or investors are, you get a double whammy at this point in the cycle. So it could be something that is quite interesting.
Yeah. Grant, you're nodding along. I don't know if there's anything further you want to add there.
No, I think Rowan summarized the sort of thinking around it quite nicely.
Okay. Then on Bidvest, the question is, in spite of the sharp drop in its share price, is Bidvest still a hold, or is Bidcorp a better deal? Grant, staying on you.
I think Bidvest is a hold, certainly. Again, it's a high quality business. If you're a long-term investor, you shouldn't see these short-term volatility. These things are actually opportunity, not something to be concerned about. As long as the company's fundamentally robust and there's nothing happening there that you're concerned about, which is exactly the case right now. The operationally they're sound. They're still moving, in the right direction, but they probably ran ahead of themselves in terms of they over-earned a little bit on the renewables and the freight. And so the market got a bit excited. It's had about a 20% pullback. And I think it's looking attractive again. If anything, I would start nibbling here. Whereas Bidcorp, fantastic business, nice rand hedge component. I don't think it's cheap, and it's not as going to grow at the same rate as Bidvest, but it offers a different sort of quality, cash generative sort of niche. It's Bidvest is SA predominantly, and Bidcorp is global. Yeah. So you're getting two different things out of these two companies.
Yeah.
Rowan, and obviously two different industries.
Yeah. Having said that, would you agree with Grant that actually this is an opportunity to buy Bidvest? Would you be buying Bidcorp at all, or do you think it's too pricey? Because it really has had a very good year.
Yeah, it's quite a good choice, as sort of Grant has painted, between a global food services businesses that's predominantly a rand hedge, and then a largely services business that's focused on South Africa, to some extent the UK and Australasia. So if you like the prospects for South Africa, of South African stocks going forward, and it's really on valuation grounds and an improvement in load shedding, although that has a little bit of negative drawbacks for Bidvest just in terms of the renewable side. But more generally, I think you would be backing a South African equity. I think Bidvest at this point is quite interesting. Or you want to diversify, move away from the South African economy, then Bidcorp would be the right stock to go for. Personally, we like South African equities here. We think they'll do better next year. Peak interest rate cycle, economic growth will pick up from here. Load shedding will abate to some extent. I think the issues of Transnet will also be resolved in a reasonable span of time. Bidvest may benefit from privatization and partnership in some of those assets. It's fairly well positioned. So, we would say we're more SA bulls at this level, and then we would back Bidvest. Okay,
just one quick question from me before I get to your stock picks. I haven't had any viewers asking about Nampak today, which came out with results which were horrible. A 4 billion rand loss. They took impairments, currency losses, and then the revelation that on the debt, on the equity that they raised earlier, they paid 335 million rand in fees. I mean, that's just unbelievable, but I suppose that's what happens when you're over a barrel. Just a quick comment on Nampak from both of you. Grant, would you be interested in backing Nampak as a
So no, it's one that I've said a couple of times, even on this show, that I wouldn't buy, I wouldn't own it. Perhaps the balance sheet's been repaired now. They probably had to pay a lot of underwriting fees for that rights issue. And I think, for those who are brave, you can dabble there. There's always money to be made on a turnaround or recovery play, but it comes with a risk attached. And I don't have a clear view of their strategy for recovery. This has been a losing story, a recovery story for about 8 years now, from what I can recall. So unless I can see a clear demonstration that they're turning the business around, I would leave it alone.
Yeah. Rowan, very quickly from you, same view?
I think they are cleaning house and big bath approach and taking the big impairments that they need to. One comment I did see that was sort of a take on aluminium cans, that they are positive from a renewables perspective because they're very recyclable and they will get further traction. So that was sort of a kind of bullish outlook. But it is a tricky investment case. You'd really need to do your homework.
Yeah, okay. So Rowan, sticking with you, what's your stock pick this evening?
So we're choosing Absa, so along the theme of sort of a better outcome next year for the South African economy and I guess South African equities. Absa's actually underperformed the rest of the banks quite significantly. It looks really cheap on its various valuation metrics, both the PE and dividend yield. We think that, they won't be overly sort of cyclically impacted by rates coming down too quickly in the endowment effect. And we rather see, I guess, an improvement in the outlook for equities. And it's a cheap stock and in a strong market position. So we see it from these levels performing fairly well.
Okay, great. Grant, how about you?
My stock pick was Bidvest.
Okay.
It was easy to answer earlier. It's had a good 20% pullback from its highs in August. And I think we share the view that the outlook for South Africa, things on average will be better next year and 12 months from now than they are now, whether it's load shedding, whether it's post-elections, whether it's interest rates, inflation, etc. And so broadly speaking, the SA economies should see some sort of value unlock, if you like, with improving sentiment and flows. And Bidvest is very well placed in every nook and cranny of this economy. Plus the ancillary benefits of, they do benefit from load shedding currently. The renewables section of the business is doing tremendously well. And so that if load shedding's worse and Transnet's worse, their freight has been benefiting, their renewables has been benefiting. So you've got a little bit of a bad outcome hedge there. But really are good operators presenting a good entry point below, a decent multiple for a first time in a while. So, that would be my pick.
Okay. James, thanks very much. We'll leave it there. Thank you for your insight this evening. Nice to chat to you both. Grant Nader is from Benguela Global Fund Managers and Rowan Williams is from Nitrogen Fund Managers. Coming up next at the close. Stay with us.